Hello all. Good evening and welcome. I am Divya Krishnan, and on behalf of CareEdge, I welcome you to our discussion today on India's healthcare in its transformational era. We sincerely appreciate your time in joining us. We would like to welcome our esteemed guest speakers for today. Ms. Sandhya Jayaraman, Group Chief Financial Officer, Narayana Hrudayalaya Limited, Mr. Vivek Kumar Goyal, Chief Financial Officer, Fortis Healthcare Limited, and Dr. Bhaskara Bollineni, Chairman and Managing Director, Krishna Institute of Medical Sciences Limited. Dr. Bhaskara Rao is in another meeting right now and is expected to join us shortly. This session will be moderated by Ranjan Sharma, Senior Director at CareEdge Ratings. We will commence the session with a presentation by D Naveen Kumar, Associate Director, and Ravleen Sethi, Associate Director at CareEdge Ratings. This will be followed by a panel discussion and Q&A session. In case of queries, participants are requested to key in your panel, and we will take up your queries during the panel discussion. Now may I invite Naveen and Ravleen to make their presentation, please.
So in this slide, the left-hand side bar chart represents the per capita beds per 1,000 people. Here it can be observed that the developed countries like South Korea and Japan has over 10 beds per 1,000 people. And even the developing countries like China, Brazil, and Colombia have one or more beds per 1,000 people. However, India is considerably low at about 0.5 beds per 1,000 people, indicating significant underpenetration and high scope for improvement. The right-hand side graph presents per capita doctors per 1,000 people. Here also, we can see that the number of doctors per 1,000 people is over 4 for Germany and Austria. And even in developing countries like Mexico and China, it is over 2. But when it comes to India, there are about 13 lakh doctors as on FY22 against a population of about 140 crores. So it works out to be about 0.8 doctors per 1,000 people, which is considerably lower. Now let us see what Indian government is doing in order to bridge this gap and increase the healthcare availability in the next slide. The government under Pradhan Mantri Jan Arogya Yojana announced rupees 89,000 crore outlay for the healthcare sector for over 6 years in the Union Budget 2023-24 to strengthen the existing National Health Mission for developing capacities for primary, secondary, and tertiary healthcare systems. As of August 1st, 2023, a total number of 24.33 crore Ayushman cards have been created. The Indian government is planning to introduce a credit incentive program worth of 50,000 crore to boost the country's healthcare infrastructure. The Government of India approved continuation of National Health Mission with a budget of rupees 36,000 crore under the Union Budget 23-24. With all these incentives, the total healthcare expenditure by the government has increased from 2 lakh crore to approximately 5.5 lakh crore during FY23. In terms of increase, it is about 150%. However, in terms of percentage GDP spent, it has increased from 1.2% during FY14 to 2.1% during FY23 as per budget estimates, and same is expected to increase to about 2.5% by FY26. This is factoring various incentives taken care by the government. The chart on the right-hand side presents the total market size of Indian healthcare industry, which stands at about 9.5 lakh crore during FY23. Hospitals contribute major share of healthcare industry, that is about 55 to 60%, contributing about 5.74 lakh crore. Followed by pharmaceuticals, which contribute about 2.05 lakh crore, and the remaining market share is contributed by diagnostics, medical equipment, health insurance, and others. As hospitals contribute major share of healthcare industry, let us discuss more about the growth prospects of this segment in detail in the next slide. The left-hand side pie chart presents the percentage share of private hospitals to government hospitals. Indian hospitals sector is more skewed towards private hospitals, which contribute about 65 to 70%, while the remaining 30 to 35% is by government hospitals. The chart on the right-hand side presents the compounded annual growth rate of the hospital industry during pre-COVID era, COVID era, and post-COVID. It is observed that the industry during FY14 to FY20 has reported a CAGR of about 10%. However, during COVID, the growth of the hospital industry was impacted as the patients have postponed the elective surgeries. Nevertheless, with subsiding of the COVID, the growth of the hospitals has bounced back, and thus it has reported CAGR of about 11% during FY20 to FY23. Going forward, CareEdge estimates that the industry to grow by about 12% because of the various factors driving the growth. Some of the factors which can drive the growth, which are driving the growth of this industry are aging population, rising income levels, increase in public health expenditure, surge in medical tourism. Coming from general population perspective at large, it is observed that India spends significantly high out-of-pocket expenditure towards healthcare. As penetration of insurance and out-of-pocket expenditure is inversely correlated with each other, let us discuss how health insurance performed during last decade in next slide. India has one of the highest shares of out-of-pocket expenditures in healthcare. However, the government aims to increase the public healthcare expenditure to about 2.5% of GDP by FY26, which is from the approximately about 2.1% from the current level. The government of India spends little in healthcare given the size of the economy, which drives the higher out-of-pocket expenditure. Despite the decline in the past few years, India's out-of-pocket expenditure as percentage of the current health spending is about 50% during FY20, which is significantly high as compared to that of even lower and middle income countries. As per a survey, it is said that about 80 to 85% of the inpatient hospitalization did not even have any coverage. So in this slide, we can see that the total healthcare premium, which includes government-sponsored schemes, group insurance, individual family floater, and individual other than family floater, has grown at a CAGR of about 18% during FY14 to FY21, and the percentage of health insurance premium of the total non-life insurance premium has also increased from 25% to 30%. However, during COVID, the insurance premiums have increased considerably, reporting a CAGR of about 25%, while the contribution to non-life insurance has also increased to 35%, which is primarily attributed to realizing the necessity of such insurance policies during health emergencies and also partly due to increase in the insurance premium. With increase in awareness of importance of health insurance policy, CareRatings estimates that the insurance premiums to grow at a healthy CAGR of about 22% during next 3 years. The health insurance premiums during H1 FY24 has grown by about 25% compared to H1 FY23. Now let us see what are the fundamental and structural growth drivers of hospital industry in next slide. CareRatings has identified aging population, rise in income levels, along with insurance penetration, increase in public healthcare expenditure as the fundamental growth drivers. With increase in life expectancy and more number of people going forward entering into the age of 50 to 70 years in the next decade, wherein the need for medical emergency arises from, would act as major growth driver. Apart from that, rise in income level and increase in insurance penetration, as discussed in the earlier slide, and increase in the expenditure by the government would act as tailwinds for the growth of hospital industry. Further, CareRatings has identified surge in medical tourism, growth in communicable and non-communicable diseases as structural growth drivers. India has seen gradual uptrend in medical tourism given the relatively low cost of surgery, critical care, and advanced technology hospitals. We shall be delineating on this aspect more in detail in subsequent slides. This slide presents a number of PEDs that have taken place during past 3 to 4 years. It is observed that whether in pharma or hospital sector, the global PE players are showing their keen interest to acquire the stake in Indian companies. And some of the recent noteworthy PE deals in hospital sector are Blackstone acquiring stake in Care Hospitals from TPG, Manipal Hospitals acquiring stake in Amri Hospital from Imami Promoters, Temasek acquiring stake in Manipal Health Enterprise. So overall, we see good traction in PE deals in hospitals industry. With this, I would request Ravleen to take the presentation forward.
Thanks, Naveen. Good evening, everyone. I'll be taking you all through the operating and financial metrics in the industry, having a look at the operating first. The current graph represents the trend over the years in average revenue per occupied bed, which is RPOB. The green bars here present the RPOB, and the blue line represents the year-on-year growth in the RPOB. This data is for the listed set of 9 big players in the industry, and the growth over the years has been healthy in this parameter, except the period when COVID had stuck. RPOB is typically a function of case mix, the payer mix, and the annual price hikes taken by players. RPOB in pre-COVID years has registered healthy growth. However, the outbreak of COVID led to deferment of surgeries by the people. Further, there were price caps on treatments to COVID patients, and as such, the sector did not register any growth in the RPOB during that year. After COVID-19, the rising awareness of health insurance led to more people opting for health insurance, and the hospitals have been focusing on high-end surgeries such as oncology, transplant, and neurology. And these treatments are high-paying surgeries, which led to increase in the overall RPOP. Post-COVID, the sector registered a phenomenal growth of 15% in RPOP in fiscal of 22. And even on a high base of FY22, the industry again registered a growth of 9% in RPOP in fiscal of 23. In FY23, the rise in the international patients as well contributed to the RPOP increase, which was subdued in the fiscal of 21 and 22. We expect that industry will record a growth of 4 to 5% going forward in RPOP for the next 2 years. And players are already reporting healthy growth in the current year as reflected in the first half, the reported numbers. Moving on. There on the left-hand side of the graph, the bed capacity along with the occupancy has been depicted, where blue bars represent the bed capacity for the sample set of players analyzed by CARE, and the turquoise line is the occupancy level. In fiscal 19 and 20, the occupancy for the selected sample trended at 58 to 59%. And in fiscal of 21, on account of the COVID-19 outbreak, which restricted the patient movement and the fear of infections impacted the hospital operations significantly as people deferred their surgeries. The occupancy levels dropped to 54 to 55%. And since COVID patients used to have a longer stay, the average length of stay, or ALOS as it is called, had increased during the COVID years, as is visible from the graph in the right-hand side. As elective surgeries resumed post-COVID and hospital inpatient footfall increased, the industry witnessed a steep rise in occupancy levels to 62% in FY22 and thereafter 64% on an average for all the players put together in fiscal of 23. And as COVID patients reduced, the ALOS also reduced, as is visible. Looking at the healthy demand drivers and need for quality healthcare, the rising occupancy levels, players have announced capacity expansions, both green and brownfield. And it is expected for the sample set that we are presenting that close to 3,000 beds will come up over the next 2 years across various geographies. The occupancy levels therefore may moderate marginally due to the upcoming fresh bed capacity in the industry. They will, however, remain range-bound and strong at 62 to 64% on an average, even on a higher bed base, on the back of rising awareness for health, the deeper insurance penetration, rising chronic ailments, and medical tourism gaining traction. Let us now have a look at the payer mix for the industry. The cash and the self-pay is a high-margin business and contributes highest to the payer mix of the leading hospitals. The current industry average of this in the revenue mix is about 40%, and the collection cycle here is quick and the most efficient amongst all the options. The insurance, or the TP as it is called, is also a high-margin business for the hospital chains and have a collection cycle ranging from 30 to 50 days. The mix currently stands at 28% from this, which has increased from 21% in share in the FY19, thanks to the rising awareness and penetration of insurance and the healthy, which was post-COVID. Moving on, the 22% of the mix is contributed by government schemes like CGHS and private and the public sector units, which generally is lower RPOP business, and they hence have lower margins and have a longer collection cycle. International tourism, which today stands to close to 8% of the revenue share of the leading hospital chains, this mix had dropped to significantly 3 to 5% during COVID times, but has bounced back post-COVID pretty strongly. And the balance 2 to 3% of the payer mix is contributed by private ties that corporates have with hospitals. As we move forward, we expect insurance and international mix should expand in the total pie. India today sees great influx from the medical tourism. It has also the potential to become the hospital for the world. With this thought, let us have a look at the medical tourism in the country. In recent years, medical tourism in India is on a gradual uptrend, given the relatively low cost of surgery, critical care, the advanced technology the hospitals use, and the e-medical visa. In the left graph, it is visible that the medical tourism has been on rise in India till calendar year of 2019, before plunging by almost 73% in the COVID-stuck year, the year which marked ban on travel and various other restrictions. Post-COVID, year 21 registered growth in medical tourism. It was, however, still low given the travel restrictions which were there in that calendar year. However, year 22 marked a significant comeback by the medical tourist, which almost stood at pre-COVID levels. And in the current year, which is the calendar year of 23, we are expecting this to register further growth. India ranks among the top 10 countries for medical tourism and is most preferred, especially among the Asian countries. The medical tourism and industry is expected to grow, which is also driven by the government initiatives like Heal in India. And this particularly benefits the hospitals in the metro cities since they're the prime beneficiaries from the international patients flow. Also, almost more than 80% of the medical tourists arriving in India are coming from countries like Africa, West Asia, Southern Asian nations, and medical tourists also from UK and Canada are now on the rise. Moving to the financial metrics and credit profile of the players now. The left graph depicts trend in revenue for the sample set of 9 listed players, where green bars represent the revenue and the blue line represents the operating margin. In line with continuous growth in RPOP for the industry, the revenue as well has been growing at a steady pace except the COVID stuck year. Post-COVID, with confluence of positives playing to cushion the RPOP and occupancy growth, the revenue registered healthy growth. Sample set as being reported here registered a 41% growth in revenue over an otherwise muted fiscal of 21. And even on a high base of fiscal of 22, sector again reported a mid-teen growth in fiscal of 23. And we are expecting the growth momentum to continue going forward. And as per CareEdge estimates, it must grow at 8 to 10% over the next 2 years. Operating margin profile of the players, as has been here for the sample set, they were in the range of 12 to 15% pre-COVID. The outbreak of COVID, it led to hospital chains working on various cost optimization measures, which along with improving RPOB and operating leverage, helped players report an impressive improvement in the operating margin, which improved by almost 800 to 900 bips to close to 22% in FY23. Operating margins, as per our estimates, is likely to be range-bound at 22 to 23% as new supply will come in. We don't forecast margins will improve significantly from over here. Further, few players continue to report margins healthy and north of 22%, depending on the location and other factors. Looking now at the trend in the return on capital employed in the sector, which are presented on the graph on the right-hand side of the slide. Being a high gestation business where greenfield hospitals usually take 3 to 5 years to break even, the ROCE in the coverage universe of the players have been low in the past. However, with incrementally lower capex in the last 2 years by major chains and improvement in the operating margins, the return on capital employed improved significantly to 17% in fiscal of 22 and 23. Now with new supply coming in and a large chunk of it being brownfield, and further players are now also open to do asset light and O&M models, which save them a huge upfront cost and which are more ROCE accretive. We expect the return on capital employed will moderate though, but it will remain high and healthy and above the pre-COVID levels. Let us now have a look at the leverage and the coverage indicators for the similar sample set of players. With improvement in the operating profitability, the cash accruals increased and players have significantly deleveraged over the last 2 to 3 years. Certain players got listed while a couple saw equity infusions, which were also deployed in reduction of debt of the players. The net leverage, which is net debt to EBITDA, which used to be around 3 times in FY19, dropped significantly to 0.6 times levels in fiscal of 22 and 23, as is depicted in the left graph. With drop in debt, the interest cost reduced and improved operating profitability cushioned the improvement in the interest coverage indicator, as is depicted in the graph to the right. Both leverage and coverage will moderate marginally from FY23 levels as players will resort to expansion mode, part of which will be debt funded, but they are expected to continue to remain strong and healthy over the next 2 years. Let us now have a look at the CareEdge rated portfolio, which is on the left-hand side. We at CareEdge rate 88 companies across small, mid, and large hospitals, and a significant 73% of the portfolio is investment grade, which is BBB and above rating bracket, and 45% of the portfolio is A and AA rated. Since the sector has performed well, the credit ratio in the sector for the care-rated universe has been very healthy. This is visible from the graph on the right. Credit ratio is the ratio of upgrades to downgrades for a given period. Now, post-COVID, sector has reported a healthy credit ratio of 10, which means Care did 10 upgrades for 1 downgrade in that year, and it stayed healthy in fiscal of 23 and even in H1 of FY24. Moving on, we almost come to the end of the presentation. We have briefly summarized here the driving factors and emerging trends in the sector, along with the key monitorables. So going through the emerging trends and drivers first, the demand in the healthy, as has been discussed throughout the length of the presentation, and insurance penetration is rising, which is positive. Medical tourism offers a huge opportunity for the domestic players, and India has of late gained a lot of recognition with government coming up with a lot of initiatives. We believe the overall contribution from this segment as the sector moves ahead in its growth journey will improve. Specialty mix is evolving, and a lot of hospital chains have now forayed into diagnostics and they are ramping it up pretty quick, which is increased healthcare awareness is supporting the diagnostics. Also, in the last few years, a lot of evolvement has happened on the technology front in the healthcare sector. We see robotic and AI gaining a lot of traction, which also increases efficiencies and drive growth as they're involved in high-end procedures and they entail a larger ARPA. So tech is reshaping the healthcare. On the monitorable side, the regulatory risk, while the impact of the regulatory intervention on the industry has not been very significant, but any stringent or adverse regulation or price ceilings may have an impact on the pricing power of the players and thus affect its margins. Any event-based litigation or reputation risk continue to be the key monitorable in the sector for the credit profile of players. Also, players have announced huge capacity expansions and some are scouting aggressively for the inorganic route. Any significant debt-funded acquisitions or capex may impact the credit profile of few players. Lastly, the sector is growing and there is a need for quality healthcare in the nation. And therefore, the growth in the sector has to be complemented well with quality healthcare personnel as well. These quality healthcare personnel will come at a cost attached. So both the factors need to be cautiously factored in while planning expansions. With this, we come to the end of our presentation. Thank you, everyone. And I now hand over to Divya to take the session forward. Over to you, Divya.
Thank you for your presentation, Naveen and Ravleen. As mentioned, all attendees are requested to key in their questions with which we will take up during our panel discussion. Now may I invite Ranjan Sharma to take over the session, please. Ranjan Sharma is a Senior Director, Large Corporate Ratings at CareEdge. A seasoned credit rating professional with over 18 years of experience, Ranjan has led several teams in rating operations at CareEdge. Over to you, Ranjan, sir.
Thanks, Divya. So before starting the panel discussion, let me briefly introduce our esteemed guest speakers for today's webinar. We have Dr. Bhaskara, who is expected to join shortly. Ms. Sandhya Jayaraman. Ms. Sandhya Jayaraman joined Narayana Hrudayalaya as Group CFO in December 2021. Prior to joining Narayana, she had close to 20 years of experience in Wipro and Unilever groups, performing a broad spectrum of roles such as business partnering, audit and risk, Ombuds ethics program, digital transformation, financial planning and analysis, supply chain finance, and project management. She was placed in Asia's 100 Power Leaders in Finance by White Page International. She has also been placed in the FE Power List by Financial Express and conferred the title of Most Innovative CFO in the Business Leadership Awards 2022. She has been awarded thrice by the Institute of Chartered Accountants of India as a CA CFO of the Year, Professional Achiever of the Year. An alumna of the ICAI, she had secured an All India rank in foundation, inter, and final examinations. She is a regular speaker at national and international conferences of the ICAI and CFO forums on various topics. Our next panel member is Mr. Vivek Kumar Goyal. Mr. Vivek Kumar Goyal is a seasoned professional with over 30 years of experience in finance. He joined Fortis Healthcare as CFO in 2019. Prior to joining Fortis, he had worked with Tata Housing and Development Company, Ballarpur Industries, Saw Pipes Limited, and Indo-Asian Fuse Gear Limited. Mr. Vivek is a qualified chartered accountant from the Institute of Chartered Accountants of India, a company secretary from the Institute of Company Secretaries of India, and holds an LLB degree from University of Delhi. We shall now start the panel discussion. My first question is for Mr. Vivek. The health insurance premium has shown healthy growth of about 20 to 25% during past few years, as we saw in the presentation. However, as compared to other global markets, the health insurance industry in India continues to remain highly underpenetrated, covering less than 1% of the population. Can you please share your views, throw some light on what is inhibiting its penetration, and how do you see this going forward over next 4 to 5 years?
Yeah, sure, Ranjan. Thank you. Thank you for inviting me on this conference. As you rightly pointed out in the presentation, there is a good growth in the insurance penetration, 22% plus, and I personally expect that this is going to go up further because of the awareness, healthcare awareness in the population, and the COVID has further, bring the need of health insurance in the masses, and my expectation it will further go up, maybe double digit for at least 4 or 5 years.
Okay. In fact, we ran a poll on this on the social media, and yesterday and today, in terms of what is the CAGR growth in health insurance premium during FY23 to FY26, and most of the respondents have said view of around 15 to 20% CAGR growth, which they are expecting.
Yeah.
Thanks a lot. My next question is for Ms. Sandhya. As we can see, the total number of beds or doctors available per 1,000 people in India is significantly lower compared to other developing countries. And can you please share your views on what structural changes needs to be done in the industry so as to address this issue?
Sure. If you start with, I think there is one aspect that I want to clarify, which is that bed capacity per se is not it's a surrogate measure, but it's not a complete representation of, the healthcare continuum of services. For example, take Narayana itself as an example. We've hardly added any bed in the past 3 to 4 years, and I don't think we're adding any significant bed in the next 2 years. But we've been able to improve our throughput significantly. So therefore, bed addition has to be looked at as a measure, but it is a measure and not the measure. So that with that little caveat, I think there are 3-4 aspects that one may want to look at. One is there is a lot of capital that is chasing healthcare, like we were talking before the session started, and you also mentioned it. It came out in the presentation as well. So definitely there will be a change in terms of the capacity that is getting created, though it may be slightly lopsided, because that a lot of the addition is happening where there is more paying capacity. And therefore, one of the structural interventions which is required is that some of these capacity creations where the financial model is not very clear is compensated by the government. So a good, healthy mix of capacity which is created by the government as well as by private players will give that balance. That is one aspect. The second aspect is it's not just a factor of beds, but also a factor of talent. We still need many more doctors and many more nurses in our country. The good part is that the medical seats per se have doubled in the past 10 years. Now that's an amazing thing. I think we had a decade back, we had less than 50,000 medical seats. Today we have more than 1 lakh seats. And similarly, there is a significant surge in the nursing talent pipeline. So I think those structural measures that will help us get access to quantity of talent, I think they've been put in place. The quality of talent, both the government and the private sector have to equally invest. Many healthcare organizations today run DNB programs for super specialization for doctors that helps them improve the specialist talent. Similarly, they run training programs for nurses. So there's a lot of work going in that direction. The final call out I want to have is technology is a game changer in healthcare. It can completely disrupt the way care is accessed. You don't need a bed for every single treatment. In fact, there is a Uberization of healthcare waiting to happen. That's what is the latest notion. So I think there is a lot of play from a technology point of view, and technology has multiple layers. One, of course, is digitization of the experience. Second is the care itself is getting faster, so that will enable lesser number of beds and faster, better technology, better equipments, and better techniques. So scientific advancements. So all of them are set in motion in our country, and I think we are going in the right direction, albeit a little slow, but I think we're going in the right direction.
Thanks, ma'am. Thanks a lot for great insights into this. Now, Ms. Sandhya, next question is also for you. So we have seen that the medical tourism to India has now almost reached pre-COVID levels. What, according to you, from here on, could be the growth rate you expect in medical tourism, and what could be its key drivers? And what can make India an even greater attraction for medical tourism compared to some of the other Asian countries like, say, Thailand, Malaysia, etc.?
Sure. So, as Narayana, we have always taken a little bit of a contrarian view on medical tourism. We believe that over a period of time, medical tourism will taper down and eventually become insignificant. The
Okay.
reason being that every country is investing in its own healthcare resources and opportunities. And we believe that as a country with 1.4 billion people, our domestic opportunity is immense, and how much ever medical tourism could generate, it can never compensate and match with the art of the possible on what we can do for our domestic patients. So we've always taken a view that medical tourism is a passing cloud, and till there is till it is that it is there, it will continue. But eventually, every country, and we have seen that at some point in time, there were certain countries from which we used to get a huge inflow of patients, and now those countries have stopped because someone has either gone and set up care there, or in India, 20 years back, if you had a heart problem, you would have to go outside India to get treated. Today, nobody goes outside India to get treated unless it's a very advanced form of advanced cancer, or where the technology does not exist. This transformation happens across countries. So we don't believe medical tourism is going to be a big driver in the future.
Okay.
Though the quality of care in India has constantly improved, and therefore people who are coming will get access to good quality care.
Okay. Thanks. Now, Mr. Vivek, we wanted to have your view on how do you see the mix of the way the medical tourism is likely to grow in your view, as well as the increasing penetration of health insurance. How do you see that these two twin aspects leading to the shift in the payer mix over next few years for the hospital sector?
Sure, Ranjan. So I think my view is slightly different on the medical tourism. The reason being, I agree with Sandhya to the extent that every country need to spend more on and will come up to mark to meet their country medical needs. But having said that, the way the India is coming up and the type of investment India is doing, and the cost of medical treatment is quite low if we compare with the other countries. So one is there will be a time gap by which this medical tourism may grow in the country, and medical tourists may continue to come from the other developing or underdeveloped countries. And secondly, this price difference is play a very big role in attracting medical tourism, and especially with the type of treatment India is able to provide these days, and the type of medical facilities we are having in the country, that also lead to good attraction for the medical tourism. And I think this may continue at least for 4 to 5 years, and only time will tell how much it will go. At least 4 to 5 years, there is a clear visibility that we can expect 10 to 15% growth in the from this pair. Coming to your second question on the insurance penetration, the insurance penetration is going up, and as I mentioned earlier, there are lot of awareness in the masses, and people are there is a lot of increase in the group medical insurance policies, and people are taking insurance, and this is also to go with the paying capacity per capita income of the people, and people want to have a quality medical facilities. For that, insurance is must. So I believe over a period of time the cash will slightly come down, and it will be compensated by the insurance, and other payers may remain like that.
Okay, fair enough. It's always nice to have different perspectives on a given point. It's welcome. Now, Ms. Sandhya, so I think you obviously spoke about the growth drivers. So just wanted to have your perspective on what is the expected growth rate in terms of revenue we foresee for the hospital sector over next 2 to 3 years, given all the factors which are into play currently, which Ravleen also touched in her presentation. So over, say, next 2 to 3 years, what is the rate of growth in revenue for the hospital sector you foresee?
See, I don't want to make a guesstimate on the growth rate for the sector.
Yeah.
I think you people are more equipped and competent to do that. But I do want to acknowledge that what's happened in India in healthcare is nothing short of magic, actually. From 2010 to 2020, life expectancy has gone up. The under 5 per thousand mortality has gone down by almost 50%. You spoke about the private equity story. The entire journey has been very, very energizing. Now, I just want to call out the top 3, 4 drivers which will probably enable. One is you spoke about the out of pocket expense on healthcare, and Vivek spoke about insurance penetration. I think that's a big opportunity that will change the game in terms of people accessing care. The second part is the robustness with which the industry is investing. And again, we spoke about that. There is, say, I want to give an example, say, calcium scoring test. Earlier, say 5 years back, 7 years back, no one would do a calcium scoring test. With that, you can predict the risk of a cardiac arrest for the next 10 years. No one would do it 5, 7 years back. But now almost most of the hospitals have invested in capability to do a calcium scoring. So it gives a greater predictability for people, and therefore they're able to address issues much faster. So the technology that India is investing in, I think that's the second aspect. And the third aspect is clinical talent, which we spoke about. So all of these, I think, will bring together very good growth or access to care for patients, and that will enable us to see robust outcomes. And more than I want to say healthcare growth, robust and high quality outcomes to our population.
Yes, ma'am. Fair enough. So actually, we ran a poll on this also. In fact, our view is also that in terms of the hospital industry's revenue growth rate over FY23 to FY26, we expect it to be between 10 to 15%. And the poll which we ran on social media, around 65% of the respondents, they have also given that view of 10 to 15%. But fair enough. So you wouldn't like to guesstimate, so that's fine. Now, Mr. Vivek, come to that consolidation part. So we have seen a lot of larger players taking over smaller players in the industry, as well as PE players expressing their keen interest in the Indian healthcare sector. So how do you see in terms of the consolidation playing out in the sector over next few years?
Yeah, sure, Ranjan. So I see there are a lot of M&A activities going on, will come up in this industry. As you know, the sector is becoming more attractive. We have discussed in this call itself that there is a double-digit plus growth we are expecting. The ARPOB is growing very fast. There is an increase in the availability of doctor and nurses. All this giving signal that this sector will further grow. And with that growing and the profitability also in your presentation, you have touched upon 22-23% profitability with 15% growth expectation. So all these indicators are very good from the investment point of view, and that is what is attracting the capital in the sector. And we are seeing lot of private equity deals happening. in the sector, and I expect this may continue, and there will be more consolidation happen, and plus there may be some new player may also come to take advantage of this growing sector.
Okay. Ms. Sandhya, a related question on this aspect. Can you share your views on how these acquisitions or PE deals are benefiting the industry, say in terms of better quality treatment, better affordability, etc.? Are we seeing such benefits through these deals or acquisitions? Certain insights coming into.
Sure. One is that the healthcare industry is extremely capital intensive, and there is a lot of investment that is required to be able to provide high quality care. And historically, in India, healthcare has always struggled with that cash crunch or inability to be able to generate the cash flows that are required for the quality of the investment that this country needs. So, the access to capital, I think, has made that big change. The second aspect is that when smaller organizations are being acquired by more organized players, we are also able to see institutionalization of processes, more technology coming into play, better focus on patient experience, more digitization, technologies like EMR are taking space. So that is enabling the quality of care and the experience of care be better for the patients. The only aspect which I'd call out as a to watch out is that healthcare is a very long gestation business, and therefore to be able to generate meaningful returns in healthcare, there is a certain reasonable wait period that is little dissimilar to some of the other industries, and so that patience to get there will help in developing a more holistic healthcare solution for the country.
Okay. Ma'am, we would also like to have a view on how do you see the bed capacities getting added in the sector over next 2 to 3 years, and which are, if you look at India, maybe which geographies you believe the capacity additions are expected to be on the higher side on a relative basis?
Sure. So the first part, of course, is I still want to start with my disclaimer that bed capacity is not the only measure. But
Correct.
if you see the CAGR of say FY17 to say first half of FY24, the combined bed addition by the top 11 listed players would be say less than 3%. But and this is not a statistics that I can vouch, but this is more what we've picked up from talking to multiple people like yourself, that there is expectation that there will be at least 40% incremental bed capacity that will get created over the next 4 to 5 years. And if you see the commentary from all of us listed companies, you hear their earnings call, all of us are talking about capacity addition. All of us are saying that either it's greenfield or brownfield or inorganic. All of us are talking about how we are going to create more capacity. So definitely the bed capacity story is extremely positive. In terms of geographical distribution, I think if you have to make a profitable large setup, 1,000-bed kind of setup, it has to be in the tier 1 and the top 50 cities. That's where really the large capacities will come up. Mostly they will have aggregator capabilities in the extended wealthier cities, but I don't know if private sector will create capacity beyond that. I don't know. I cannot predict, but at least because I'm a finance person and I look at an Excel sheet, so for me to make an Excel sheet in a market which is beyond the top 50, I don't know how it will work out from a viability point of view.
Fair. Mr. Vivek, we have seen that players have been able to sweat their assets in the last 2 years. Higher ARPOB, occupancy, along with various cost optimization measures, have contributed towards improving operating margins in the sector, which we already saw in the presentation. Now, do you feel these margins are sustainable for the industry given new supply which is expected to come up and the gestation associated with the sector? And what is your outlook on the operating margins for the sector over, say, next couple of years?
Yeah, I think it is a very important question, and we always keep deliberating on this. So, as you rightly mentioned, there a lot of work has gone in the industry toward cost optimization as well as sweating the asset. and most of the listed players are operating at 65+% occupancy level.
Correct.
But having said that, in our network itself, there are hospitals, many hospitals, I will say, which are operating at 75-80% type of occupancy level. So from that angle, it shows that there is a tremendous further scope to improve one the occupancy level, and secondly on the the cost side, there are, as the companies going for expansion, there will be economy of scale will come, and that will lead to the profitability. So I think 22 to 25% is a very much sustainable EBITDA margin, and unless some drastic changes happen, like one risk you have mentioned about government policy change and things like that, which are beyond anybody control.
Fair enough. Sandhya ma'am, what obviously we have deliberated and discussed a lot on the positives, what is happening good in the sector. I wanted to have your view on what are the major challenges you foresee for the growth of the hospital sector in India. So maybe one or two critical challenges.
The one big one is inflation, and there is always the fear that you may not be able to pass on the burden to the customer. 1/5 or 1/4 of many of the hospital revenue is from government contracts where the prices don't change, and there is also a significant portion that comes from insurance contracts where at least in the short term prices are fixed. So there is always the challenge of managing price increase, and with the global volatility, and most of our equipments are imported, so which means we are significantly exposed to currency risks, and that I think is one aspect. The second aspect is that there is still a lot of out of pocket, and therefore there is still while we are very optimistic about insurance growth, it is still a journey, and in many ways the entire the whole journey is very lopsided from a patient point of view. When they many times when people need care, they don't access care. So for example, people will not do a pre-medical checkup because they're always afraid of finding something. Though most of us know in our mind that you have to find something to solve it, but we're always afraid. So by the time people come for care, probably it's too late, or people don't access care that they need to take. So I think the awareness aspect of why people need to take care of their health on time, that also is something that there is work to do. And finally, the last call out I have is that we will risk some unbalanced capacity in the near term, because everyone is chasing capacity in tier 1 and tier 2. So there may be excess capacity in urban and under capacity in non-urban areas. And with PE money and quicker return expectations, we need to see how the competitive landscape will play out.
Fair enough. Mr. Vivek, your take on the same question in terms of the key challenges which you foresee for the hospital sector?
So I think apart from what Sandhya has rightly mentioned, those are all the challenges we are grappling with. I think one challenge is about the frequent government policy changes and price control and things like that. That is another thing which I would like to voice. And sometimes those changes are not rational also. So those type of things are further a challenge to the industry, apart from what Sandhya has said.
Fair enough. With this, we conclude the panel discussion, and I thank you for sharing your deep insights on the sector. Now I'll hand it over to Divya, who will be opening the floor for the Q&A session from the audience, which will start shortly.
Thank you, Ranjan sir. Thank you, sir. Dear participants, we will now begin with our Q&A session. You're requested to key in the queries in your panel. Thank you so much. Ranjan sir, you can start taking the queries.
Fine. In fact, one question which we have received from Mr. Tejas is, with so much competition in the pharmacy sector, does it make sense to focus on core hospital services than to focus on diagnostics and pharmacies? So, and what are your views on different segments in the healthcare business from hospital point of view? Maybe Mr. Vivek, if you can take a shot at this.
Yeah, sure. I think it is a very important question, and because as we say, there is a lot of competition in the pharmaceutical and diagnostic chain. especially the new age player. There are a lot of discount which is getting offered, and sometimes the rate at which the tests are getting done, it is below the cost. Okay, so from that angle, I agree with it that there may be short term pain in the sector segment, but I will say in over a period of time this need to be corrected. And as people stop burning cash, the segment should come up. And I think from that angle, for a long term player, both pharmaceutical as well as the diagnostic is a good sector to work in.
Okay. Ms. Sandhya, the next question is for you. It says that since quality doctors largely don't like to move to tier 2, tier 3 cities, what can the sector do in terms of expanding to these type of cities?
Yes. So, two aspects. One, of course, is that there has to be like government participation in being able to provide care in these tier 2, tier 3 cities. And the second aspect is that the entire care continuum need not be delivered inside a hospital. There is a certain component which is of a consultation, a more fact finding of the health condition. Then there is a diagnostic component. Then there is may or may not be a surgery, or a operative requirement. And then there is a post-operative kind of care. So there are multiple aspects of these parts of care that can be delivered at home or at a secondary care facility. And therefore the way the solution will emerge over a period of time is that there will be people who will operate across the niche. There will be certain people who will cater to certain parts of the need, and certain people who will build hospitals, large scale hospitals, and deliver high quality care at meaningful costs because of the scale that they are able to operate at. So the solution will come when the ecosystem comes together. If one person or one operator tries to solve the entire care problem, it may be difficult in the short to medium term.
Okay. So I think this was the last question from the audience for today's webinar. I shall now hand it over to Divya for her closing remarks.
Thank you so much, sir, for moderating the session, and Naveen and Ravleen for your presentation. Once again, thanking all our guest speakers for their insightful views. It was genuinely a pleasure having you on our webinar. And lastly, thank you to all our participants for taking out time and for being a part of this CareEdge webinar. For any further queries, feedback, or suggestion, please write to us in the feedback mail. Goodbye for now, and requesting the